Welcome to another tutorial video. We are going to address a concept about which we've received many questions in this video, which is negative goodwill or bargain purchases in merger models. So the typical question we get about this topic goes something like this. Can you explain what happens in an M&A deal if the equity purchase price is less than the seller's common shareholders equity? Do you get negative goodwill? What is the accounting treatment for this type of bargain purchase? As usual, I'm going to give you a very short answer here, and then we're going to go into it in a little more detail and go through some Excel-based examples, as well as a made-up example and a real-world example of when this type of deal would take place. The short answer is that no, you do not create negative goodwill because it cannot exist under either US GAAP or IFRS. Instead, in this scenario, you would create zero goodwill and you would record an extraordinary gain for the absolute value of that goodwill on the combined company's income statement after the merger takes place. The accounting is similar, and you allocate the purchase price in a similar way, but you may have to create new intangible assets based on the real method for doing so. In other words, assigning some type of value based on their future cash flows, rather than just making them simple percentages of the allocable purchase premium. Also, you're going to have to use a maximum zero function around goodwill to ensure that it does not turn negative. On the financial statements, you record an extraordinary gain on the income statement. On the cash flow statement, you reverse it because you always reverse gains and losses on the cash flow statement. And you also reverse the extra taxes the company paid on that gain within the deferred tax line item. On the income statement, if you look at it, it will appear that the company has to pay extra taxes on this gain, but in reality, it does not. Let's take a quick look at what that looks like in Excel. So here's a deal where a company has paid $250 million, but the seller has a book value, a common shareholders equity of only $312 or $313 million. So the allocable purchase premium is negative. And if we were to just add up everything here, let's take our allocable purchase premium and then all of our write-ups and adjustments, we would get to negative $203 million for the goodwill created. Now, to avoid that scenario, we put a maximum zero function around the whole thing, and then we record an extraordinary gain equal to the negative of that entire amount. And we also put a maximum zero around that. Then on the income statement, under other income and expense, we have this line item for the extraordinary gain or loss, $203 million. The company's pre-tax income goes up and their net income also goes up as a result of this extraordinary gain. On the cash flow statement, the net income is higher. We reverse this gain by subtracting it out. We also have to reverse the taxes on it. So it appeared that the company had paid higher taxes as a result of this gain and the higher pre-tax income, but in reality they didn't. So we record a positive adjustment for those taxes on the cash flow statement. Now on the balance sheet, the company's cash balance ends up being higher as a result of this. The company's shareholders' equity is also certainly going to change because the net income has changed. And then one of the deferred tax line items will also change. We have a deferred tax liability here, which links in directly to this deferred income tax adjustment on the cash flow statement. But you could also model this as affecting the company's deferred tax asset instead. So that's a quick walkthrough of how this works. In this tutorial, now that I've given you the short answer, we're going to go into this topic in a bit more detail and look at it in three parts. First, I'm going to explain why a bargain purchase like this would take place and explain why a company would actually be willing to sell for less than its common shareholders' equity. Then in part two, I'm going to explain why the accounting is a bit confusing and a simpler method that you can use to combine the statements like this in an M&A deal. And then in part three, we will go through a real-life example of a bargain purchase that took place in the last financial crisis and see how a real company recorded negative goodwill or the gain on the bargain purchase on its financial statements. Let's go to part one first and talk about bargain purchases in general. Typically, these happen when the seller is distressed, it's running low on cash, it has high debt or other obligations, and it needs to sell as soon as possible. Its options are to liquidate and potentially get less than its shareholders' equity if the fair market values of its assets are low, or to sell to another company. Now, the advantage of a sale is that it keeps the company alive in some form. So at least some of the employees will probably keep their jobs, and the customers that are using the company's products or services will keep getting delivery of those services or products, at least in some form. And it could easily result in a higher price than the company would receive in a true liquidation scenario. Here, I'm going to go through this example with Starbucks acquiring this other company, Cocoa Cream Donuts, which is imaginary. This company, Cocoa Cream Donuts, has declining revenue, high capex, rising expenses, rising debt, and a quickly declining cash balance. It's not exactly bankrupt, but it needs to do something quickly to turn itself around. Here's what its financials look like. The company has increased its store count and increased many of its lines of business, but the problem is that the sales per store has fallen quite dramatically over the past few years. If you look at it on the statements, its revenue is falling by around 10% per year. Its operating income margins and growth rates are also falling. You can see here that its operating margins have fallen from 10 or 11% down to less than 5%, so its expenses are rising. If you look at the cash flow statement, its capital expenditures are also very, very high. They exceed the company's cash flow from operations, which is not really a scenario that you ever want to be in. And then on the balance sheet, its cash balance has fallen from around 50 or 60 million down to only 25 million in the span of just 2 years. Its debt has also risen modestly, and in the future, it's projected to rise even more. Now, this company clearly needs to do something to turn itself around. They have projected that eventually revenue growth will return and the operating margins may not increase, but at least operating income will grow a little bit. And they're also saying that they expect their capital expenditure requirements to fall. We don't know how credible these projections are. An acquirer would certainly doubt them, but that's what the company thinks is in its future. Now, if this company were to liquidate, if you look at its balance sheet, it has shareholders' equity of around 312 million, but on the asset side, its goodwill is going to be worth nothing in any type of liquidation. So that immediately reduces the price by about 26 million. And then of its other assets, accounts receivable and inventory could easily be written down if random other parties just buy parts of this company. And even if its PP&E could easily be written down because many of its store locations are probably not worth much to other buyers. Maybe they're worth something to other companies in this industry, but probably not to random other companies or real estate investment firms or places like that may want to buy parts of this company. The bottom line is that in a true liquidation scenario, as a result, the company could easily receive less than its 312 million of shareholders' equity. So if a company like Starbucks were to see this situation, and they might make a solid offer to purchase the company for, say, 250 million, it's less than its shareholders' equity, but it still represents a pretty decent multiple. It's around 6.4 times enterprise value to EBITDA if you go through and do the math based on the company's balance sheet. Now, Starbucks doesn't really think the company's tangible assets are worth all that much, but it does like the company's intangibles, its brand, its customer list, its intellectual property. And that's why if you look at the math here, we have around 150 million of this 250 million purchase price going to these intangible assets, both indefinite lived ones and definite lived ones. Now, in the purchase price allocation process, we are still going to write off the seller's common shareholders' equity and its goodwill, and we're still going to adjust the PP&E and intangibles, and we'll still create a new deferred tax liability based on the fact that depreciation on that PP&E write-up and the amortization of these intangible assets and the eventual write-down will not be tax deductible. So we go through all those normal steps, but the difference is that, as I said in the beginning, we have to use a max zero around the goodwill calculation, and for the extraordinary gain, we also have to do something similar. We have to look at the negative of what we did to create the goodwill and put a max zero around this. This is important because if the purchase price were much higher, say 500 million, and we actually got positive goodwill, we don't want to record an extraordinary gain in that scenario because we don't get anything there. We only get this extraordinary gain when the goodwill created is potentially negative. So that's a little bit more detail on why a bargain purchase like this would happen. Let's now go into part 2 and talk about why this is confusing and a simpler way to think about this scenario. So under the old method for bargain purchases, you allocated the negative goodwill proportionally to the acquired company's assets. So you might write down their accounts receivable, their inventory, their PP&E, their other assets by some percentage. And if some amount still remained after doing all that, then you would record an extraordinary gain for that. Now, You no longer do that, despite what some sources say. Some websites, some accounting textbooks haven't been updated. But under both US GAAP and IFRS, you now simply record an extraordinary gain. So there's no more proportional allocation of this negative goodwill. The rules on this actually changed quite a while ago as of the time of this video. The other thing that makes this scenario confusing is that few, if any, accounting textbooks actually walk through the full set of changes on the financial statements under a bargain purchase. They tell you the basic idea about how you record this extraordinary gain, but they don't do a full walkthrough of what happens and how the statements link together. One problem with our method that also makes this a little bit confusing is that immediately post-transaction, the balance sheet does not balance. It's off by the amount of this extraordinary gain. Now, of course, after that, in the first full year following the transaction close, the balance sheet immediately goes into balance. But some people would look at this and say that this is not acceptable and the balance sheet should balance immediately after the transaction takes place. We don't really think that matters because the end result, which is what you really care about, the first full period following transaction close is what matters, and the end result there is the same. But if you wanted to fix this, a simpler way to do it would be to credit the shareholders' equity of the combined company with the extraordinary gain in the balance sheet adjustments. So you could skip recording it on the income statement, you could skip the reversal on the cash flow statement, and you could skip the reversal of the taxes paid on the gain on the cash flow statement as well. It's similar to how in most M&A deals, you deduct the transaction fees from shareholders' equity rather than showing them on the income statement. Even though in reality they would show up there and be a non-cash tax deductible item, you often just simplify it and show the adjustment in the balance sheet adjustments in the deal instead. So if you want to see what that looks like, let's go up and let's just delete the extraordinary gain on the income statement. Now by doing that, our net income will be the same. We won't have any reversal on the cash flow statement, and our deferred income taxes will just be based on the depreciation and amortization of the intangible and PP&E write-ups. And then on the balance sheet, under shareholders' equity in our credit column here, we are going to credit the extraordinary gain right here. And now our balance sheet balances immediately afterward, and the entire extraordinary gain flows into shareholders' equity. So that is a much simpler way that you can do this, and arguably it's better because we get an immediate balance and it's a whole lot simpler to track and walk someone through. The disadvantage is that it's not exactly what happens in real life. You are going to get some changes with the taxes and the cash balance and other things, but this is a much simpler and easier method. Let's now go into part 3 and talk about a real life example of negative goodwill. So back in 2008 to 2009, it was very similar to the apocalypse. The markets had crashed and were crashing. Banks were failing or being acquired, or failing and then being acquired. The economy was in full recession, and there were many, many distressed sellers. Now, in the financial sector especially, there were a lot of failures and distressed sales there. One example is when West America Bank Corporation acquired County Bank for pretty much nothing and really just assumed control of the bank, even though County Bank's net assets were worth around $48 million. I took these numbers from the filings from 2009 to 2010 when the deal took place. You can see here that they went through the full purchase price allocation and they recorded a bargain purchase gain of $48.8 million. As a result, West America recorded a gain in acquisition on its income statement, reversed it on its cash flow statement, and then adjusted its cash taxes down, just like we did in our model. So here's the income statement. They record this gain on the acquisition, $48.8 million, no negative goodwill, just a gain on the acquisition. As a result, their pre-tax income and taxes are both higher, and their net income is higher as a result of this gain as well. And then on the cash flow statement, they have this higher net income, and then they reverse the gain down here with a negative, and they don't say explicitly what happens with the cash taxes, but here, basically, they are increasing the deferred tax liability by around 40 to 45% based on the fact that they didn't really pay taxes on this gain on acquisition. So that's a quick and simple example of how a company might record this type of change in real life with an actual deal that has already happened. Let's do a recap and summary now that we're at the end. Bargain purchases are most common in distressed deals where the seller needs to sell as soon as possible and the buyer makes a decent, better than liquidation offer. In the purchase price allocation process in this scenario, you have to use a maximum zero function around the goodwill calculation to prevent negative goodwill, and then you record an extraordinary gain for the absolute value of goodwill. So if you get negative 100 in goodwill, then you have a gain for 100. On the statements, the simplest method here is to simply credit shareholders' equity of the combined company with this gain to ensure a balanced balance sheet immediately afterward. It's slightly more accurate to record the gain on the income statement, reverse it on the cash flow statement, and then reverse the taxes paid on it, which means that cash, deferred tax assets or liabilities, and retained earnings or shareholders' equity will change on the balance sheet. This topic is not terribly important because bargain purchases are quite rare and it doesn't really matter outside of distressed or restructuring groups and deals. But if you're working on one of those types of deals, then you will certainly need to know about how this works and the mechanics of this process.